Welcome back to the deep dive. Okay, so inflation is still, biting,
Mm.
and everyone wants a bit more financial security. So today we're really digging into passive income strategies for 2025. We've got a bunch of sources here listing something like 25 different ideas.
Yeah, it's a really important topic. And our goal isn't just to list things, but to give you a kind of roadmap. Because passive income, well, it can be the foundation for building wealth, maybe supplement retirement or, even eventually replace your main job. It offers that buffer.
Right, but there's a catch, isn't there?
There definitely is. It's this core truth. Passive income. It's hardly ever truly set it and forget it.
Okay, yeah, let's tackle that right away. That's the big myth, I think.
Yeah.
So what is passive income? Like legally and maybe more practically?
Well, officially, the IRS defines it as regular earnings from a source. Well, not your employer or a contractor. So think rental property or maybe a business you're not actively running day to day, like stock dividends or royalties from a book you wrote.
But practically.
Yeah.
You mentioned that initial effort. That seems key.
It's everything. I saw a quote from Todd Tresidder in our materials.
Oh, yeah, I saw that too. He said something like, the appeal is get rich quick, but the reality is you just give the work up front.
Exactly that. So we need to adjust how we think about it. You're putting in a huge amount of time, or maybe capital, right at the start, to build something, an asset, that then hopefully needs just minimal ongoing work.
Minimal, but not zero.
Right. Not zero.
Right.
You still have to, say, update that online course you created or fix a leaky faucet in the rental property. There's still maintenance.
Okay, so if it's not completely effortless, what is it definitely not?
Good question. It's definitely not your primary job that's active income.
Hmm.
And it's not really a second job either, where you're still trading your time directly for money, showing up and doing the work.
Got it.
And another thing, it's not just owning assets that don't produce income, like holding crypto that you're not staking or stocks that don't pay dividends. They might go up in value, sure, but that's not cash flow hitting your bank account regularly.
Makes sense. Okay, let's dive into the first big group of ideas then. We're calling this passive income for creatives. This seems perfect for listeners who maybe have more time and specific skills, but maybe not a lot of starting cash. Substituting expertise for capital, essentially.
Yeah, exactly. This is all about creating something once, like an ebook or an online course, maybe a webinar series that you can sell over and over again. You're using your niche knowledge, maybe something you're really good at, and leveraging low-cost digital publishing platforms.
What I found interesting here is how often the first product, like maybe a short, cheap ebook, it's not even the main goal. It acts more like a lead generator, right? To pull people towards something more valuable, like a full course or a membership.
That's a very common strategy. But, and this is a big but, the risk here is mostly about your time. Tresidder, again, he called it a massive amount of effort. And the thing you create, it really has to be great.
So you can spend months working on something.
For potentially very little reward, yeah. It often takes trying a few different things, launching multiple products, before one really catches on. Persistence is key there.
Okay, so that leads into other digital ideas like creating an app or maybe starting a blog or a YouTube channel.
Right, an app, well, the potential upside is huge if it takes off. Think of a hit game or a really useful utility. But the flip side is it's a super crowded market, popularity can vanish overnight, and then there's all the compliance stuff like global privacy laws. It gets complex fast.
And what about blogging or YouTube, using those free platforms?
That's leveraging your unique expertise again. Maybe you're the world's expert on, I don't know, Minecraft strategies or something. Income there usually comes from ads or maybe getting sponsors. But, here's the catch-22.
Let me guess.
Mhm.
You need an audience first.
You need a big audience first, a really engaged one to attract decent sponsors or ad revenue. So you're putting in all this time and effort up front, building that following, potentially for months or even years, before you see any significant passive income. It's a gamble on trends and audience building.
So the takeaway for this whole creative section seems to be high effort up front, trading time for potential future income, but with a significant risk of low or delayed returns.
That sums it up pretty well. It requires passion and persistence.
All right, so we've looked at trading time, but what if you do have some capital you're ready to put to work? Let's shift to the second big category, investment-based passive income, where your money does more of the heavy lifting.
Yes. And the classic starting point here is the stock market, specifically dividend stocks. This is probably one of the purest forms of passive income. You own a piece of the company, a share, and they send you a check, usually every quarter, just for holding it.
But, you hear warnings about just chasing the highest dividend yields. Our sources mention that too. A CFA named John Graves, He strongly suggested beginners look at ETFs, exchange-traded funds. Why is that?
That's really about managing risk. High dividends can sometimes be a sign a company is in trouble, maybe unsustainable payouts. An ETF bundles together potentially hundreds of stocks into one single investment. So you get instant diversification.
Ah, so you're not putting all your eggs in one basket.
Exactly. It spreads the risk. If one company in the fund cuts its dividend, it doesn't sink your whole investment. Plus, ETFs are generally easy to buy and sell, very liquid, and pretty inexpensive. It makes it much simpler for novices.
Okay, and what about preferred stock? That came up too. Sounds a bit different.
It is a bit different. It acts kind of like a hybrid between a stock and a bond. They usually offer quite attractive, stable quarterly payouts.
But there's a catch there too, I assume.
The main one is interest rate sensitivity. Their price tends to move often inversely with interest rates. So again, diversification through a preferred stock fund is usually the smarter way to go for most people.
Got it. Okay, moving into fixed income, things that pay regular interest. Where's the starting point?
The absolute safest place is probably a high-yield certificate of deposit, a CD, or just a high-yield savings account. These are typically FDIC-insured up to $250,000 per depositor per bank. So very secure. You can shop around online for the best rates nationally.
The downside.
The main risk is simply that the return might not beat inflation. So while your money is safe, its actual purchasing power could slowly erode over time. Still, for pure safety, it's top tier.
Right. Then there's the bond ladder. Sounds kind of old school, but maybe effective.
It's a classic strategy, especially for retirees needing predictable income. Instead of buying one big bond that matures way out in, say, 10 years, you buy several smaller bonds with staggered maturity dates. Maybe one matures next year, another the year after, and so on.
And the benefit of that is?
It reduces reinvestment risk. As each bond matures, you get cash back that you can then reinvest at whatever the current interest rates are. You're not locked into one rate for a decade.
Makes sense. But bonds have risks too, right? Default risk, interest rate risk.
Absolutely. Corporate bonds always carry the risk the company could default. And like preferred stocks, existing bonds generally lose value if interest rates rise, which is why, again, many people prefer bond ETFs for diversification. Spreads the risk across many different bonds.
Okay, one more in this category. Peer-to-peer lending, or PDP. Sounds interesting. Lending directly to others.
It can offer potentially higher interest rates, yeah. You use a platform, like Prosper was mentioned, to lend money to individuals who might not qualify for traditional loans. You earn income from the interest they pay.
The risk seems obvious, though.
Default risk is definitely the big one. These are typically unsecured loans. If the borrower can't pay, you could lose your principal.
So how do you manage that?
Diversification is crucial. The platforms usually let you invest small amounts, maybe even just $25, across a whole bunch of different loans. Spreading your money out reduces the impact if one or two loans go bad. But yeah, it's definitely vulnerable in economic downturns.
All right, a lot of options there for using capital. Let's pivot now to strategies that seem to blend capital and maybe a bit more hands-on work. Real estate comes to mind first.
Yeah, real estate often sits in this middle ground. Traditional rental properties like buying a house or condo to rent out can be very effective for passive income. But it's almost always more work than people anticipate. As Graves pointed out, you really need to calculate things carefully beforehand.
Like what?
Your desired return, obviously, but also the full cost of owning that property, mortgage, taxes, insurance, maintenance, potential vacancies. And then you need to figure out the rent required to cover all that, plus give you the profit you want.
And the risks are pretty significant too, aren't they? Tenants not paying, damaging the place.
Exactly. Or just struggling to find tenants at all, especially if the economy slows down. It's definitely not just mailbox money without effort.
So for a more genuinely passive approach to real estate,
that's where REITs come in, real estate investment trusts. These are companies whose whole business is owning and operating income-producing real estate, think shopping malls, apartment buildings, office towers. They have a special tax structure where if they pass most of their income through to shareholders as dividends, they pay very little corporate tax themselves.
Ah, so you get exposure to rental income and property appreciation, but without being the landlord yourself.
Precisely. You buy shares just like a stock. And even better, buying a REIT ETF gives you diversification across different types of properties and geographical regions, much safer for most investors.
Okay. And then there was crowdfunded real estate.
Yeah, that's another option. Platforms connect investors with specific real estate deals, often private ones you couldn't access otherwise. You might invest a smaller amount, say $5,000 or $10,000, into a specific apartment building project, for example.
Benefits and risks.
Benefit is diversification and access to potentially higher return private deals. The main risk is liquidity. Your money is usually tied up for the duration of that project, which could be several years. And like all real estate, it often uses a lot of debt, making it sensitive to economic downturns.
Got it. Okay, beyond the big categories like stocks and real estate, the sources listed some, well, more niche ideas, like affiliate marketing.
Right. Affiliate marketing is where you promote someone else's product or service, usually using special links on your blog, social media, maybe TikTok or YouTube. If someone clicks your link and buys, you get a commission.
Sounds easy, but I bet the commissions are small.
They typically are, yeah, often just like 3 to 7%. So you need a lot of traffic, a really big audience clicking those links to make meaningful money. And audiences can be fickle, right? They might jump to the next influencer quickly.
True. What about that one about putting ads on your car?
Yeah, car wrapping. There are specialized agencies that will pay you to wrap your car in advertising if your driving patterns match what their clients want, like commuting in a busy area.
So if you're driving anyway.
You could potentially earn a few $100 a month, pretty passively, yeah. The big caveat here is scams. This area is apparently rife with fraudulent operations, so you have to be really careful to find a legitimate company. Don't pay any upfront fees. That's a huge red flag.
Good warning. Okay, we've covered a huge range of ideas, from things needing mostly time to things needing capital to these hybrids. How does someone even start to choose?
Well, it boils down to a few core factors, right? How much capital do you have? What's your tolerance for risk? What actually interests you? And what skills do you have? And it's important to remember what the sources warned. The easier it is to get into something, the lower the barrier to entry usually, the more crowded that field is going to be. Competition will be higher.
So if someone's listening and has basically no money to start,
Then you really have to focus on those strategies where you substitute time and expertise for capital. Creating that ebook or course, maybe coding software if you have those skills, building that blog audience. It's about leveraging what you do have, which is your knowledge and effort.
and if you do have some capital,
Then you can lean towards the more purely passive options. Things like high-yield savings accounts, CDs, dividend ETFs, bond funds, REITs. Places where your money can genuinely work for you with minimal ongoing interaction required from you.
Greg McBride, the CFA mentioned in the sources, had a good quote about diversification here, something about fishing.
Yeah, he said, you'll catch more fish with multiple lines in the water. It's about not putting all your hopes on one stream. But you also have to balance it. Don't start so many new things that you neglect the income streams you already have or burn yourself out. Find a sustainable mix.
Okay, so for someone totally new to this, feeling maybe a bit overwhelmed, what are like the absolute easiest first steps? Low risk, low effort.
I'd say the top 3 easiest starting points are probably 1, opening a high-yield savings account online. Super simple, very safe. 2, buying a certificate of deposit, a CD, also very safe, locks in a rate for a set term. And 3, maybe buying a broad market REIT ETF, gives you instant diversified real estate exposure passively. Those require minimal capital and very little ongoing effort.
That's helpful. Now, for people who maybe get a few streams going, there was an advanced point about taxes, minimizing the tax hit.
Yes, this is really important once you start generating decent passive income. If you structure your passive income activities as a legitimate business, even just a sole proprietorship, you can potentially open up self-employed retirement accounts.
Like a solo 401k or a SEP IRA. You can get those through regular brokers, right?
Good.
Like Fidelity or Schwab.
Exactly. And the advantage is huge. Depending on the account type, you can contribute a significant portion of your passive income earnings into these accounts. For example, a solo 401k might let you contribute as both the employee and the employer, potentially sheltering a large chunk of income.
And that money grows tax deferred.
It grows tax deferred, and your contributions can often reduce your current taxable income. So it's a powerful way to both save for the future and minimize the taxes you pay on your passive earnings today. Definitely something to look into as things scale up.
Wow, okay. We've covered a lot of ground.
Yeah.
From digital creations to dividends to real estate and even wrapping your car. It really drives home the point that the best passive income strategy isn't a single answer. It's completely personal, depends entirely on your own situation, your money, your time, your skills.
Absolutely. It's all about finding the right fit for you. But ultimately, whatever path you choose, the goal is building that financial resilience, that security buffer. It really comes down to investing something now, whether it's your time, your money, or your expertise to create more financial freedom down the road.
So thinking about that, investing something now. Here's the final thought we want to leave you with. Building on that idea of using what you have, what is one single piece of unused capital you possess right now? Maybe it's a bit of cash just sitting there. Maybe it's some specialized knowledge only you have. Or maybe it's just an empty corner of your garage or an unused parking spot.
Think about that. What's one resource you already have that's currently idle that you could potentially turn into a small passive income experiment, maybe even starting this week? Just something to get the ball rolling.